Joining us now to discuss is Damien Courvalin, head of energy at Goldman Sachs. Welcome to the set. Thanks for joining us.
Pleasure to be here.
So why did crude rally today? Is it trade hoax or is it actually the IEA report that we saw?
Sure. So the IEA report in itself actually was positive in that it didn't reduce demand estimates further. It's the first time in several months that we don't have another downgrade of demand. And in fact, there are a few silver lining on the demand side. Chinese demand continues to beat expectation. European demand in September was good. US in October. So I think that's probably the first driver. I think what we're seeing as well on the supply side is despite this higher estimate of global supply, the US sector continues to show signs of slowdown. The rig count today fell again. And so I think we have to put it into context. And what the agency showed and what the EIA and OPEC showed is, on aggregate, the market is likely balanced next year.
What does that mean, though, for U.S. producers? And I ask that because you mentioned the rig count, lowest rig count since April 2017 now.
So I think the key takeaway is we've reached a price point, 55 TI, where U.S. producers are slowing down sufficiently. It's the capital markets, the equity markets, the debt markets, and the combination of oil prices here that is leading to this slowdown. Now, the key question is it too much of a slowdown relative to fundamentals? And our view is the market will be balanced next year. If you look at fundamentals, they're relatively benign for next year. You have strong growth in non-OPEC, non-US. Projects started 5 years ago. You have this slowdown in shale, but shale is still growing. And if OPEC maintained its cut, the market is balanced. And so the price action of the last 5-6 months, $60 Brent, in our view is what will translate for the next 12 months.
What about longer term? Is there a risk that geopolitical concerns out there are underpriced, maybe US commitment to its allies in the Middle East?
So I think in the short term, what is key is supply disruptions have declined. If you look at Iran, Venezuela, there's little left to fall. The Saudi issue has been resolved. Outside of those countries, disruptions are at their lowest level in more than a year. And there's a détente currently between Saudi, Iran, and Yemen. Now, the key, though, is nothing has really been resolved on that front, right? In Iran, today, they just increased gasoline prices by 50%. Their exports continue to fall. Enrichment continues. In Iraq, you have social unrest in the south of the country. So those issues, of course, can creep up again. Escalation can happen. The one, though, caveat is, if the world was worried about demand and sees plenty of supply next year, it's really hard to price preemptively this risk premium for a potential other shock.